Many pioneers are no longer asking when Pi will be listed on exchanges or how much it might trade for in the short term. Instead, a deeper and more consequential question is beginning to surface. What exactly is Pi becoming? For the first time, that answer is not emerging from speculation, price forecasts, or market excitement, but from code itself, through the emergence of the Pi coin Soroban monetary contract, a moment where definition is fixed before price, where structure is deliberately established before trading, and where Pi begins to move from being perceived as a digital project toward being understood as a monetary system in formation. Unlike the majority of crypto projects that follow a familiar path, launching with hype, rushing toward exchange listings, encouraging volatility, and only later attempting to justify their foundations, this contract does not attempt to answer how much Pi is worth today. It includes no trading logic, no liquidity mechanisms, and no speculative incentives. Instead, it focuses on something far more fundamental: defining what Pi is at a system level. In that sense, this is not a conventional token contract designed to move value around, but a monetary charter designed to establish rules, consistency, and meaning before markets are ever allowed to respond. The technical choices embedded within the contract are highly symbolic. The use of arbitrary precision arithmetic, mathematical consistency, infinite-scale accounting logic, immutability, and integrity locks communicates a clear and intentional message. Pi is being shaped as a standard, not a speculative asset. Prices can fluctuate by the hour, markets can overreact to narratives, and sentiment can swing wildly, but standards are meant to endure. By fixing the definition before exposure to open markets, Pi follows the same historical sequence as legitimate currencies, where accounting rules, trust mechanisms, and systemic coherence are established first, and valuation emerges later as a byproduct of real use. Even the language associated with the contract is revealing. Terms such as unforgeable, sovereign, and self-healing are not decorative developer language or marketing slogans, they are constitutional concepts. They imply a form of money designed to resist arbitrary alteration by individuals, corporations, or governments, positioning Pi not as a managed digital product but as a system-level currency. In this model, trust is enforced by protocol rather than authority, stability is derived from structure rather than promises, and monetary integrity is preserved by design rather than policy decisions. Some pioneers may naturally wonder why this contract is not officially branded as a Pi network monetary release. That separation is intentional and strategic. Directly linking a formal monetary definition to a live, global user network too early would invite regulatory misclassification, speculative behavior, and legal complexity. Instead, the framework is prepared quietly, the definition is sealed carefully, and the formal connection is deferred, not denied, remaining fully consistent with Pi's long-standing philosophy of contribution before profit and utility before speculation. This phase does not imply instant liquidity, sudden price discovery, or immediate access to open markets. What it does signal is far more significant. Pi has entered the stage where money is defined before it is traded, where standards are fixed before prices are assigned, and where institutions, markets, and financial infrastructure will be expected to adapt after the framework already exists. And at the center of this transition are the pioneers who contributed time, identity, and participation long before value was visible, because throughout monetary history, it is always those early contributors, who acted without guaranteed profit, who ultimately anchor legitimacy, trust, and adoption when the world finally begins to assign a price.